I'm Jim Frey with PCE Investment Bankers, and in today's edition of M&A University, we're talking about how to calculate net working capital and its impact on your net proceeds in a sale process. Determining your net working capital target is one of the most important tasks in a transaction. The LOI will set the target net working capital that needs to be delivered at closing. Since you get to keep your business's cash at closing, the working capital target creates a deterrent for you to have receivables paid faster than normal and increase your accounts payable. Working capital normally includes accounts receivable plus inventory plus prepaid expenses, less accounts payable and accrued liabilities. At closing, if you deliver an amount higher than the target, you will receive the difference. Conversely, if you deliver less than the target, there will be a reduction in the purchase price or cash will need to be left in the business. This payment gets trued up after the close. Components of the working capital calculation are examined closely, and certain parts of your working capital are excluded from the transaction. These excluded items typically include inventory that is aged to a point where it is considered obsolete and needs to be written off. Any prepaid expenses for asset classes the buyer is not acquiring. An example of this would be for prepaid life insurance premiums for business owners. Additionally, any accounts payable aged over 120 days are excluded. If the AP is aged over 120 days, it is typically treated like a debt obligation instead of a trade payable. Lastly, we will also exclude any accrued liabilities that result from expenses not needed to run or grow the business. An example would be shareholder bonuses. Our goal during the marketing process is to analyze the breakdown of your working capital accounts to determine what a buyer would view as essential to business growth. We then look at various metrics, usually a 6, 12, 18, and sometimes 24-month average of your net working capital. These metrics help us determine what your target working capital should be at the close of the transaction. We will then incorporate these line item breakdowns as an exhibit in your LOI, so there's no confusion at closing which categories are transferred to the seller and which items remain in your control. For example, when reviewing the current assets on the balance sheet, it is found a portion of the prepaid expenses are for your life insurance policy, which is not transferring as part of the sale. This balance sheet item is then removed from the definition of working capital assets. The business also has in the current liabilities an accrued distribution. This distribution will still be paid to the owners of the company and is not part of the normal operating expenses to generate revenue, so it is removed from the definition of working capital liabilities. The result is a net working capital target of $4.7 million. In example A, the actual working capital delivered at close is $5.7 million due to a $1 million increase in your accounts receivable. This means that the seller receives an additional $1 million at closing. In example B, accounts receivable have decreased to $4 million, resulting in a net working capital at close of $3.7 million. As a result, the purchase price paid by the buyer at the closing will be reduced by this $1 million shortfall. When closing the sale of your business, you will provide an estimated balance sheet which lays out the approximate balances of all these accounts. There's then a true-up period is allowed in the purchase agreement for you to finalize your financial statements to determine what the true level of the working capital was at close, and if any additional funds need to go to the buyer or the seller. Thanks for joining me today, and if you like this video, please subscribe to our YouTube channel so you'll be notified whenever further content is posted.